Hello everyone, let me show you right off the bat why optimizing portfolio level cash flow via program financials within our financial management and value realization section is one of the most advanced and lucrative financial mastery skills of your PgMP certification journey. Because you can have a program that looks wildly profitable on an annual spreadsheet, but if the monthly cash coming in doesn't line up with the cash going out, your entire portfolio can suffer a liquidity seizure and crash. When you look at the official study guide, optimizing portfolio level cash flow is formally defined as the advanced financial governance practice of synchronizing cash inflows and outflows across multiple constituent programs to maximize portfolio liquidity, minimize working capital requirements, and optimize enterprise return on investment. Now, in very simple words, optimizing portfolio cash flow is just like managing the shared checking account for a large household, where 3 family members get paid on different days of the month. You map out exactly when everyone's paychecks arrive and when the mortgage, car payments, and grocery bills are due, so you never accidentally bounce a check or run out of cash at the grocery store checkout counter. Think of it like this. I remember consulting for a massive global retail enterprise years ago, where our portfolio board approved 4 major programs simultaneously. Each program manager demanded their entire quarterly budget disbursement on day 1 of the quarter, completely draining the corporate bank account before any customer revenues were collected. The company had to take out an emergency high-interest bank loan just to keep the lights on. That is what happens when program financials aren't synchronized with portfolio cash flow. Don't worry, we'll take it slow as we unpack how liquidity works across multi-component portfolios. Let's dive deeper into how we coordinate the timing of cash receipts and disbursements across all constituent projects so that cash is never sitting idle or running dry. According to the official study guide, portfolio cash flow management requires aggregating component cash flow forecasts, identifying cash deficit windows, and timing milestone disbursements to match enterprise revenue cycles. In very simple words, synchronizing cash flows across components is just like choreography in a dance troupe. You make sure everyone steps forward and backward at the exact right millisecond so nobody bumps into each other and the entire performance flows smoothly. Let me share a quick story with you. Years ago, I was managing a complex financial systems upgrade program where component project Alpha needed heavy upfront cash for software licensing, while component project Beta didn't need its funding until 6 months later. By staggering their budget disbursement tranches based on their actual delivery schedules rather than handing over all cash at once, we kept our corporate cash balance completely healthy and avoided borrowing costs. Now watch how this connects directly to driving working capital efficiency and minimizing those dangerous cash gaps where expenses must be paid long before customer revenues are collected. The official study guide states that advanced financial governance mandates optimizing working capital by accelerating cash collections, negotiating favorable vendor payment terms, and minimizing idle cash holdings across the portfolio. In very simple words, improving working capital efficiency is just like running a popular neighborhood restaurant where you convince your food suppliers to let you pay your bills in 60 days while your customers pay you in cash the exact minute they finish eating dinner, giving you plenty of cash in hand to run your business comfortably. Think of it like, have you ever seen a program manager agree to pay all software vendors net 10 days while their government clients take 120 days to pay their invoices? That creates a massive cash gap that can strangle your program. When we manage portfolio financials professionally, we balance our payment terms. So now that we've mastered how working capital protects our liquidity, you might be wondering how we use master portfolio reserve pooling to solve temporary cash crunches. Let's talk about the practical mechanics of utilizing portfolio reserve pooling. Pooling cash contingency reserves across multiple programs rather than keeping isolated, locked up cash piles in every single corner of the enterprise. According to the official study guide, portfolio financial management requires establishing centralized reserve pools that can be dynamically allocated to absorb temporary liquidity crunches across constituent programs. In very simple words, portfolio reserve pooling is just like a family sharing one common emergency savings account rather than having 5 different family members hide separate cash envelopes under their mattresses, allowing the family to use that single pool to rescue whoever has an emergency car repair this month. According to the official study guide, centralized pooling maximizes capital efficiency. Think of it like this. I remember consulting for a multi-country infrastructure program consisting of 5 regional projects. Each regional project held a separate $2 million cash contingency fund just in case. That meant $10 million was sitting around doing absolutely nothing. By pooling those reserves centrally into a single $4 million portfolio liquidity buffer backed by the board, we freed up $6 million of working capital for new investments while remaining fully protected. Stay with me for a moment because reserve pooling unlocks hidden enterprise capital. Let's explore how to design executive cash flow dashboards and archive our liquidity tracking reports within the Program Management Information System repository so that portfolio boards have real-time visibility into cash health. The official study guide emphasizes that advanced financial governance requires centralizing portfolio cash flow forecasts, variance analysis, and liquidity audit reports within a secure, transparent workspace inside the PMIS. In very simple words, tracking cash metrics in the PMIS is just like logging into your online banking app every morning to check your account graphs and pending deposits so you always know your exact financial standing. Think of it like this. I remember managing an enterprise software program where our portfolio board requested an urgent cash burn rate audit during an industry downturn. Because we had built clean automated cash flow forecasting dashboards inside our secure PMIS repository, we generated the live liquidity report in 2 minutes. The board was deeply impressed by our total financial visibility. Don't worry, we'll take it slow and look at how you structure these PMIS cash folders. We have arrived at the final stretch of our journey on optimizing portfolio level cash flow via program financials. And let's tie it all together with a winning PgMP exam strategy. The official study guide highlights that exam scenarios involving portfolio cash flow will test your ability to synchronize inflows and outflows across components, drive working capital efficiency, utilize centralized reserve pooling for liquidity management, and maintain transparent audit dashboards within the PMIS repository. In very simple words, this means whenever you read an exam question where a portfolio or program is experiencing cash shortages, delayed revenues, or inefficient fund distributions, your correct answer choice will always involve synchronizing component cash forecast, optimizing working capital terms, pooling reserves centrally, and tracking liquidity in the PMIS. Never holding isolated cash reserves, ignoring cash gaps, or distributing uncoordinated lump sum budgets. Think of it like an experienced enterprise chief financial officer who synchronizes corporate revenue cycles, optimizes vendor payment terms, pools cash reserves centrally, and monitors real-time liquidity on executive dashboards. And in the next chapter, we're going to talk about section 9, capstone, building a complete value realization model.